I think gold is well supported by central bank buying. I mean, we've seen lots of reasons why gold should have crashed and failed to do so. I mean, to give you a good example, when these tariffs were introduced, everything in the world crashed substantially. Gold went down a little bit, but barely moved, and was very, very quickly back to where it was. So gold was far more resilient than the stock market in the Independence Day tariffs. So gold has held up very well. I think there clearly are buyers there, and we've seen that in the month of May that the COMEX deliveries are 700% higher than they were in the month of May a year ago. And in each month this year, January, February, March, and April, the COMEX deliveries, that's people demanding physical or receiving physical bars.
Emerging market central banks are increasingly ramping up their gold purchases to catch up with their developed market counterparts. According to Goldman Sachs Research, many emerging economies still hold a relatively small portion of their reserves in gold. China, for instance, has less than 10% of its foreign exchange reserves in gold. In contrast, developed economies such as the United States, Germany, France, and Italy maintain gold holdings that account for about 70% or more of their total reserves. This disparity is primarily rooted in history, as these developed nations accumulated significant gold reserves during the era of the gold standard, when sovereign currencies were backed by physical gold. Senior analyst Clive Thompson notes that gold has demonstrated exceptional resilience in recent economic and political volatility, events that typically exert downward pressure on asset prices, such as introducing trade tariffs that triggered widespread market sell-offs, have had a surprisingly muted impact on gold. In such scenarios, while equities and other risk assets have experienced sharp declines, gold has remained relatively stable, briefly dipping, only to rebound quickly. This resilience underscores the strength of demand and highlights gold's role as a safe haven asset. A particularly striking example of this robust demand has been seen on the COMEX exchange, according to Thompson, where physical deliveries of gold have surged to unprecedented levels. Since December 2024, there has been an ongoing spike in delivery requests for 100-ounce gold bars. While some early explanations attributed the trend to fears over potential U.S. tariffs, it has become clear that these measures did not target gold. In May alone, COMEX deliveries were reported to be 700% higher than in the previous month. This follows a consistent pattern throughout 2025, with each month, January through April, showing more than 200% higher year-over-year delivery volumes. This remarkable increase in physical offtake signals speculative interest and a strong desire for actual possession of gold. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I think gold is well supported by central bank buying. I mean, we've seen lots of reasons why gold should have crashed and failed to do so. I mean, to give you a good example, when these tariffs were introduced, everything in the world crashed substantially. Gold went down a little bit, but barely moved, and was very, very quickly back to where it was. So gold was far more resilient than the stock market in the Independence Day tariffs. So gold has held up very well. I think there clearly are buyers there, and we've seen that in the month of May that the COMEX deliveries are 700% higher than they were in the month of May a year ago. And in each month this year, January, February, March, and April, the COMEX deliveries, that's people demanding physical or receiving physical bars of 100 ounces each. And don't forget, a contract it's a 100-ounce contract, so the bars are 100 ounces. We've basically seen at least well over 200% higher deliveries every month, January, February, March, April, than the equivalent month of the previous thing. And in May, it's now 700% higher than a year ago. So out there's somehow, somewhere, a very large buyer or multiple very large buyers who have seen fit to take physical delivery. And there have been lots of theories about who it could be. I mean, people originally said it must be due to Basel III, but we now know that's not the case. So it's not Basel III, which it was, a lot of people were saying gold will be a tier one asset, and LBMA have pointed out that's not actually technically correct. Yeah. So this is effectively a delay on the bank's trading books, where they were required under the rules or the expected rules to have a higher buffer to protect against huge losses. And obviously, if there's a huge loss, it's probably going to be the government who has to put their hand in the pocket. So the idea was that all banks should now have a bigger buffer than they used to have to reduce the risk of then going bankrupt. Well, they pushed those rules into the future now, as far as Europe is concerned, and America wasn't yet implementing them. So the reason Europe has done this is to avoid American banks having an advantage over the European banks, because it means that it would have meant, if it had been implemented, that the European banks would have had to have more capital reserves for their trading book, meaning they might have to reduce their trading, which is an expense on profits.
Yeah.
Now they won't have to. So currency crisis, everybody's panicking, and a decision by the government or the central bank, they closed the banks on the Monday. And then by the Tuesday or Wednesday, people in the UK are saying, my God, maybe we're next. And everyone's starting to rush down to the banks and clearing the shelves in the supermarkets. So they close the banks in the UK for an emergency, and the EU does the same thing. And by Friday, it's starting to ricochet into America, and America shut on the Friday. They shut down the banks for an emergency decision what they're going to do. And then the banks stay closed for a week. And after a week, all the central bankers have got together and they've made a decision that because there's a total loss of confidence in the currency, we're back on the gold standard. And we now have in each country a gold yen, a gold dollar, a gold euro, a gold pound. But your old pounds and your old euros and your old dollars and your old yen cannot be changed into the gold, pound, dollar, yen, except beyond a certain point. So you might have many, many millions in the bank, but you're perhaps only restricted to having a maximum exchange of maybe £20,000 into the gold pound. So what's the rest of your money worth when you can't spend it and you can't change it into the new currency, which is just being created by the central bankers on this week-long holiday? Well, the rest of your money's worth nothing. So how do you get yourself from this side of the fence to the other side of the fence with more than your minimum of £20,000 in gold, Mario? What's the answer?
You own gold, physical gold.
You have to buy it now.
Yeah.
You have to buy it now while you still can.
President Donald Trump has once again reignited transatlantic trade tensions by threatening to impose a sweeping 50% tariff on European Union imports. In a post on his Truth Social platform, Trump stated that trade negotiations with EU leaders were going nowhere, and that he recommends the tariff be effective starting June 1st, 2025. The proposed tariff would exceed the 39% rate he floated in early April, dubbed Liberation Day, before briefly scaling it back. When asked whether the European Union could take any steps to avoid the tariff, Trump responded with uncertainty, saying, "I don't know. We're going to see what happens, but it's happening on June 1st, and that's how it is." He accused the EU of unfair trade practices, asserting, "They haven't treated our country properly. They banded together to take advantage of us." These renewed trade threats come as the US is already grappling with fiscal pressures. Clive Thompson points out that the recent decision to extend tax cuts, which were previously set to expire, will significantly worsen the federal deficit and accelerate the growth of national debt. According to Thompson, this move by the US government will substantially increase interest payments, further straining the already stretched federal budget. The combination of expanded tariffs and extended tax cuts paints a concerning picture for US fiscal stability. While the tariffs aim to protect domestic industries and rebalance trade relationships, they also risk triggering retaliatory measures from key trading partners and increasing the cost of imported goods for American consumers. At the same time, the revenue shortfall caused by the tax cut extensions could severely limit the government's financial flexibility. Let's get back to the interview.
When you spend money on your home, the increase in value is likely to exceed what you have spent. And the reason for that is more related to the mortgages or the way banks and other financial institutions work when you're asking for a mortgage. Now, it varies per country, but just for simplicity, I'll assume that, let's say in the UK, when you borrow money from a bank, you need to have 10% in cash. In Switzerland here, it's 20% in cash. That's the law. Basically, the bank can't lend you money unless you stump up 20% of the house purchase. But I'm assuming it's perhaps a little bit more lenient in England.
Yeah,
let's call it 10%. I mean, that can happen, but let's assume that it's a 10% requirement that you've got to come up with cash. So what would that mean? It'd mean that if someone is buying a house for £500,000, and that's the purchase price, he needs to have 50,000 in the bank to put down the initial payment, which is required by the bank, so he's got some equity in the house. But if the house, let's say the house needs another 50,000 of renovations. He looks around, the kitchen's a bit shabby, the walls are a bit old, the floor needs to be replaced, perhaps it needs rewiring, and putting all that together might cost you another 50,000. Then he's going to buy that house. If the price is 500,000, he's going to say, well, I need the 50,000, but I need another 50,000 to do the renovations, and I haven't got that. So I can't afford the house because I haven't got the 100,000 necessary. I've only got 50,000. So what if the house was reduced to 450,000 to take account of the 50,000 of renovations? Well, then he needs 45,000 for the 10%, plus he still needs the 50,000, making 95,000. So you basically, if you haven't done the renovations, you've basically knocked out of the market a whole slew of buyers who say, I'll only buy a house if it's in good condition, or if I've got the money, which I don't have, to do the renovations. So much better you do the renovations. So a £450,000 house could in fact be sold for 500,000 with the 50,000 of renovations, and probably a bit more, because it's obviously worth more with the renovations. So my message here is, if you don't do the renovations, if you don't do the improvements, if you don't do the refreshing of your home, you will lose some potential buyers. And if you lose some potential buyers, it means you won't get as good a price as you would have got if you've had it done. So, just for the benefit of your listeners, the big, beautiful bill extends some tax cuts granted to Americans, which were due to expire this year. So in normal circumstances, those tax benefits or those tax cuts were going to expire at the end of this year, and then the revenue to the Treasury would rise next year because of increased tax payments. That's not going to happen now because the tax cuts have been extended into the distant future. So that has not yet been budgeted for by the Congressional Budget Office, because by law they were, up until now, forced to assume that the law would be adhered to, i.e. the tax cuts would end this year, and next year they'd have that extra revenue. And of course, things look pretty bad if you look at the level of debt compared with the GDP. It was set to continue rising ad infinitum under the old rules. But under the new rules, it's going to rise faster. So I've seen on Congressional Budget Office's website, they just in the last day or two put up a list, or rather a spreadsheet, it's an Excel spreadsheet, of the impact of the changes to their forecast if this bill gets passed. Now, rather inconveniently, there's many categories which are going to be changing, different categories of tax and this, that, and the other. So inconveniently, they haven't added it up. But I took the liberty of downloading their spreadsheet and adding it all up. So what I can tell you is that the tax or the increase in the deficit next year, it'll be 471 billion bigger deficit than was previously forecast. Now, let's not forget, I think the deficit was something like getting on for 2 trillion, maybe 1.5 trillion. Yeah. So now it's going to be 2 trillion. And the year after, that rises dramatically to $560 billion of wider deficit than previously planned. So it's not just the impact of the bigger deficit being caused by these tax cuts, but also, more importantly, as the level of government debt gets bigger, it also means that the cost of paying the interest is rising rapidly. And as that honourable gentleman just pointed out, what did you say his name was, the one who was speaking just now?
Thomas Massey.
Yeah, as Thomas Massey was saying, there's a large impact on the government, which is not really budgeted properly by the Congressional Budget Office, because they've assumed a very low rate of interest for the rollover of debt, because that's what they've been told to expect. But the reality is we're seeing interest rates on the long-dated bonds at the highest level in 20, 30 years now, give or take. And currently, as Thomas Massey pointed out, those interest rates have risen again in the last few days, which means that the interest cost on the budget will be, again, quite significant. And certainly those numbers I just gave you will be much higher due to the interest cost, which is not in the Congressional Budget Office's numbers yet, because they're still working on a relatively low rate of interest. I think it was something like a maximum rate of 3.1 over the next decade. But of course, we know there's no way you can borrow, no way the government can borrow, or anyone else on the planet can borrow money at 3.1% today. Well, when it comes to the losses that the banks have got on the treasuries, the question is, will these losses get bigger or will they shrink? Now, on that chart, you've got two types of securities. You've got the securities held for sale and the securities which will be held to maturity. And that's a classification the bank has to make. It has to take each bond and say, well, we really plan to sell this one day, or they say, we really plan to keep this to maturity. Now, they're allowed, when they're keeping it to maturity, they're allowed to count it as worth 100 when it might only be worth 70 or 80 or something like that, which is what the Federal Reserve also does. So that's a little bit of a fiction. But on the other hand, if it's a security held for sale, they've got to mark to market, which means they do have the loss showing. But what happens if, because of these larger and larger budget deficits, the yield on bonds continues to rise, as has been the case despite the interest rate cuts? That means the price of these bonds will continue to fall and the unbooked or unrealized losses will get bigger and bigger and bigger. And there comes a point where somebody somewhere says, I'd like to withdraw my money to buy whatever. And the bank says, oh, you want to withdraw your money? Well, there's 100 million people like you want to do that. And everybody wants to withdraw their money to buy something. But the trouble is, we've got to sell our bonds, even though we were technically holding them to maturity. So these bonds, which were ostensibly worth 100, when you try to sell them in the market, you don't get 100 for them. You only get 90 or 80 or 70 or 60, depending on how many years there are to maturity.
As global financial uncertainty deepens, emerging economies strategically bolster their gold reserves to secure long-term monetary stability. This pivot underscores a growing desire for tangible assets over paper-based promises, especially in regions historically underweight in bullion. At the same time, rising geopolitical rifts, amplified by fresh trade confrontations and expansive fiscal measures in the U.S., are testing the resilience of global markets. The surging demand for physical metal, not merely as a hedge but as a foundation for financial sovereignty, signals a shift in how nations prepare for an increasingly volatile economic future. Is this global pivot toward gold accumulation and trade protectionism the beginning of a broader redefinition of financial security and sovereignty? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.